Rounding out the day will be Alex Cartwright with HotelSHIFT. They are doing hotel to apartment conversions. They are purchasing extended stay and distressed hotels with large rooms and high traffic locations, and then they're renovating them, achieving substantial improvement and building them into workforce housing. Alex, there you are there. Please dive in. Alex, great to see you.
No problem. Good to see you, Jimmy, and pleasure to meet everybody here. I'm Alex Cartwright, co-founder of HotelSHIFT, and I've spent a lot of time in multifamily and doing different value add projects. We are laser focused now on buying distressed hotels, which are usually older hotels, but hotels that are distressed in some kind that we can repurpose into multifamily. We think that right now, and you just saw with a lot of great presentations about new Class A development. And there's absolutely demand for new Class A apartments, but there's significant demand for apartments that are more affordable. And when I say, I usually speak to municipal governments, I use the term workforce only because affordable sometimes means capital A affordable or voucher based. But we provide workforce housing. Some of our residents have vouchers, but workforce meaning these are folks that have got jobs, but they're sub $50,000, $40,000 a year income, and they just need a clean, quality place to live that is not going to take up a third or more of their income. And that kind of housing is exactly what is very difficult, not impossible to build right now. And this kind of affordability crunch is what's driving a lot of dissatisfaction in every major city for more affordable housing. Since COVID, construction costs, as we all know, have continued to rise. And what that means is the stuff that pencils is the nice stuff. There's a term in multifamily world called if you're rent burdened or cost burdened, and then there's a term severely cost burdened. So renters are considered cost burdened if they're spending more than 30% of their gross income on rent. You're severely cost burdened if you're spending more than 50% of your income on rent. And right now, there are record number and record percentage of Americans that are in both of those categories. As a matter of fact, 41% of folks in those categories earn between $45,000 and $75,000 a year. So folks that are not at the bottom of the income bucket of the income ladder are having a struggle to pay their rent each month. And while those new A-class units look great, there are plenty of people that would love to go in an $8, $9, $1,100 a month hotel converted apartment with all bills included in order to save 20 to 30% on their monthly housing expense, especially when that's traditionally their biggest expense. And then furthermore, inventory of current affordable product is disappearing. And it's a whole business to buy kind of the C plus B class apartment building, do a value add project, upgrade it, bump the rents instead of building new. And even in Virginia, on an inflation adjusted basis, we've seen apartments that are sub $1,000 a month go down by a third over the last couple years. And so there's not only can we not expand the supply of affordable housing, but the current supply is not stable. So we want to combine the high demand for affordable housing with the high supply of older hotels. If you are not in the hotel business, you may not know that most hotels have a finite economic life. That is, unless you're a hotel that is right in the middle of a downtown major metro, at some point it's just worth building a new one. Maybe a hotel starts off life as a Hilton Garden Inn, and then 7 to 10 years later, Hilton comes in and they say, you need to do a property improvement plan, Mr. Owner. You need to replace all of the soft goods, the carpets, the pillows, the couches. And if you cannot afford to do all those to Hilton brand standard, then we're going to take our franchise name away from you. So maybe then you slip to Comfort Inn because that's a little less flexible or a little more flexible and a little less expensive brand standard. And then maybe after a few years of that, if you're not a good manager or there are new hotels being built, you might slip to an Econo Lodge, and a few years later, you slip to having no franchise at all. You're just a mom and pop hotel. You've got no edge in the market. A new hotel's been built down the street. No other hotel buyer wants to buy that product. No bank wants to lend on it. And you've got no exit plan other than to sell it for a very low price per key to somebody like me. If this is a a property that's in a good location, and if we can rezone it to multifamily before closing on it, then it can become a wonderful workforce apartment complex. We like hotels because, as opposed to office or some other kind of conversion, because conversion is the most straightforward. You already have architecture that is meant to hold lots of people at the same time. You've got individual HVAC, individual plumbing and electricity, and sometimes we're combining rooms, sometimes we're adding mostly studios. It depends on demand in the market. And of course, we're adding kitchens and sprinklers to every room. Hotels are also in great locations near major offices, near major employers, retail, major thoroughfares. I mean, hotels are kind of built in places that are high traffic where people want to be, and that cut commutes times down. And these hotels, especially older hotels, very competitively priced right now. And we think converting to C-class housing, workforce housing makes the most sense because that's exactly where supply can't expand. That's where we've seen some of the most stable rent growth, especially in high supplied markets like the Southeast. And we see durable demand for workforce housing throughout economic fluctuations. So just briefly, an overview of our process, and I'll show you some projects in opportunity zones that we've got going right now. During acquisition and due diligence, we're working with the municipality to entitle, rezone, or at least do a change of use, whatever is required on that property. We're not purchasing any property where the zoning is not done before closing because we are not hotel operators. We don't want to run these as hotels. We're in the multifamily business. Once we close, we're doing the construction. Sometimes on an extended stay hotel, depending on the layout of the hotel, it's possible to continue to operate with weekly and monthly customers as we're doing construction on another wing of the property. And sometimes we'll just shut the whole thing down, remodel, and then when we open up, we're in lease up. Once we lease up to 90%, we're going for our permanent financing. And at that point in time, we're getting evaluated at multifamily valuation, which allows us to return a significant amount of capital. We're always aiming for close to 100% of LP capital returned at refinance. And what really allows that to happen is the difference in cap rates between the hotel world and the multifamily world. Right now, you can buy hotels in the low to mid teens. In other words, an earnings multiple, something like 7 to 8. And even assuming a conservative stabilized cap rate like a 6 or a 7 cap, because these, after all, are not the A-class properties that get the 5 caps, these are more workforce properties, then you're going from an 8.5 times multiple to over a 14 times multiple. That kind of multiple expansion is hard to model in another scenario. It's hard to depend on that kind of thing, but we can, even under conservative assumptions, we can depend on the cap rate compressing, or in other words, the multiple expanding, which is where most of the value is created. So yes, there's a physical conversion to converting the hotel into an apartment complex. But most of the gains come from the financial conversion, getting it leased up to 90% and rezoned as a multifamily so that you can get appraised at a multifamily valuation. Here's a property right now that we're working on in an opportunity zone, going to close before the end of the year. It's in Roanoke, Virginia. This is a Knights Inn. I'm not sure what this was originally built as, but it was not a Knights Inn. And because of code violations and poor behavior at the hotel, these old hotels become a focal point for crime and other unsavory behavior. The city would force this hotel to shut down. And I worked with them for 18 months to get this rezoned as a multifamily. We're able to buy this property for about $17,000 per unit. And Roanoke, it's a strong market, and one of the things that we really like about is the job growth. We think that's ultimately where demand for housing comes from, and businesses moving in, indicating that job growth will continue. Low C-class vacancy and nothing new in the supply pipeline for multifamily, especially nothing even being contemplated on the workforce side here coming up in the next 12 months, which, not that we're worried about lease up or absorption, but it just makes absorption all the more easier in our mind. So this is a 120 room hotel that will ultimately become 105 units after we combine some of the smallest rooms in order to be one bedroom apartments. We're buying for the property for a little over $2 million. And we think that it is going to take around 12 months of total construction, two separate buildings of 60 units each. We'll be able to remodel one building at a time so that we can start leasing one while we're doing construction on the other. This includes a complete remodel of all the units. There's no surface that will be left as original. New HVAC and electrical upgrades, sprinkler upgrades, significant changes to the landscaping, of course, kitchens added to every unit. And we think that we'll get to 90% occupancy by about the 18-month mark. We'll be able to refinance and return significant amount of capital to investors at that time, and then we'll hold it as an apartment complex going forward. This is a bite-sized deal, only a little over $1 million in equity required to execute. I'll show you some pictures. This is one of the rougher ones that we've purchased. Not very pretty, but not abandoned and not vandalized. The rooms are functional, just old and ugly, but it's going to look like this, and bringing in a lot of the kind of colonial architectural touches to make this more in line with this area of Virginia. We'll be filling in the pool. We'll be remodeling the kind of the check-in building, the lobby into a leasing office and common space. And like I mentioned, most of the units will be studios. That's where we think demand is in the market, and we'll have a handful of one bedrooms. We're buying this at effectively 10.5 cap rate. It's our yield on cost a little under 11. We'll spend just a tad under $4 million remodeling this property on the inside and outside. And even assuming a 7.5 cap at a stabilized value, this property at the 18-month mark will be worth $8.5 million. Down the road, with assuming some modest rent and expense growth, it'll be a $10 million property. But the best part, I think, for folks that are in the opportunity zone space is our structure, where we're adding so much value and then doing a cash out refinance, which of course is non-taxable. Is there's an opportunity to get 50% or more of money back of LP capital back on refinance. We offer a little bit better terms for those who put a larger check with us, hence why the equity multiple is slightly different on the bottom row. And I'm glad to connect one-on-one and go over this with you in more detail. Let me briefly touch on another project we're excited to work on in Opportunity Zone. This is a large hotel, a 309 unit Holiday Inn in downtown Denver, 11 stories high, balconies on every building, extra large rooms. Our average room size in this property is over 350 square feet. Some are over 400. We think that this makes the most sense as a 240 unit apartment complex after combining some units to make multiple bedrooms. This property is in great condition. It just does not make money as a hotel. The owner's got healthy top line revenue, but they lose money on it every day. And we're able to buy this for $9 million from a hotel group. That works out to about $29,000 a unit in a zip code in Denver where it's very difficult to build and rents are high, in a zip code where multifamily is regularly trading in the low 200,000s per unit. So this is going to take a little bit more in CapEx. We're expecting to spend between $7.5 and $8 million to convert the property, but at $29,000 a unit basis, where frankly it's worth it. And even assuming that we stabilize at a 6.5 cap, this is a $33 million property. Add in a little bit of rent growth over the next few years, this is easily a $37-38 million property at disposition. This is a property where we do believe that we can return near 100% of LP equity at refinance. Now, this is a situation where 240 unit hotel that's 11 stories high and or I'm sorry, 240 unit apartment complex from a 310 unit hotel, there's going to be some construction timeline. And in Denver, that permitting and construction is not the easiest. We're partnering on this project with a hotel group that's done 110 ground up hotels. They're building 2 hotels in Denver right now, and they'll be the co-developer on this project. They're experts in navigating the permitting landscape in Denver, and we're excited to partner with them. So while it may take 16 months of construction and we won't execute on the refinance in our pro forma until year 3, it's worth the wait because we'll confidently give over 100% of LP equity back, and long term, we're going to have a really strong basis in a growing submarket of Denver. A little bit about myself. I spent 10 years as an academic where I was an economics professor, but always involved in real estate. I've been a project manager for one of the largest mobile home park owners in the country and executed many multifamily value add projects. My partner, who's participating here, Mr. Chang, is make sure all my numbers are right. Used to work at a hedge fund, has a PhD in statistics. My other partner, Mr. Baker, spent a life in banking. All 3 of us have deep adaptive reuse expertise. HotelSHIFT has 246 units right now under construction and leasing, and we've got about 700 units in our acquisition pipeline. These are the 2 that are in opportunity zones. With that, here's my email address. Look forward to hearing from you all one-on-one, and hope we've got a few minutes to take some questions.
We do indeed. You're our last presenter today, so I don't have anybody else to move on to. So we can soak up a few minutes of
Oh,
some
great.
questions. We had a few from Jerry here. It looks like Jerry's chatting with Ezra in the chat as well. Jerry, first question from him. He says the adaptive reuse model to multifamily seems to really be taking off. I usually hear that in respect of converting office to multifamily, but is there a particular advantage of hotel to multifamily over other reuse asset classes? That's from Jerry.
Yes. So I think that the big advantage is the architecture. You've got individual bathrooms, and you don't have that in office. You've got individual windows for every room. You've also got individual front doors, HVAC, electrical, that's all set up for individual occupancy. You just don't have that in office. In office, unfortunately, you have a lot of very flat floor plates, meaning that you've got square footage that's far away from windows. And when you don't have a lot of natural light toward the inside of the building, it's hard to convert that to livable space. So while there's office out there that can be purchased at the right basis, the remodel costs on a hotel is so much lower. There's so much distress in the hotel world right now. My attitude is, why overcomplicate it? Converting office to multifamily to me feels like building a nuclear power plant to open a can of beans. It's like, just get the can opener. There's lots of hotels out there that, like this building, if it didn't have Holiday Inn on it, you might mistake it for an older apartment complex.
Yeah, good point. Yeah, I think the plumbing for office is a huge problem, right? To overcome, in addition to the lighting and the doors. That's a good point. Let's see, Jerry, a couple more questions from him. He says, I can't remember if this was addressed, but how quickly after the capital is raised can you get to leasing a multifamily asset?
It's a great question. It depends on the asset. I would say that generally, when we're doing hotel conversion to multifamily, there's kind of 2 buckets. One, we buy an extended stay hotel, like a Marriott Residence Inn, a Homewood Suites, a Candlewood, that's got the kitchens in every room. And so in that instance, the value add is the rezoning and the leasing. Now, it's a lot quicker. There's less risk in that we're not doing as much construction, but extended stay hotels tend to perform pretty well as hotels. They already trade at low cap rates. An extended stay hotel is only something that's been around for about 20 years. So there aren't as many of them that are facing distress. And with a higher basis, that brings down the returns. And then on the other side, you've got hotels like this. They're older and they just don't work as hotels anymore. This is a huge building to rent out. They just can't make money renting it for $60 and $80 a night. And so where where we can come in and create a lot of upside, there's a long construction time. This 16-month construction timeline will be on the longer end for us. However, Denver is so strong with multifamily demand that we think we can lease this up in 9 to 10 months, and we can, and so we hitting the cash out refi by year three shouldn't be an issue. In short, Jerry, anywhere from construction until we're leasing, anywhere from 9 to 16 months of pure construction before we start leasing.
Couple questions from Muru. Wants to know, one, what's the minimum investment amount, and two, um, when an investor invests, are they investing in the two projects combined, or are they investing they investing separately in these two projects? How are you structured?
Yeah, thanks very much. We do single asset syndication, not a fund. So you can pick the asset that you invest in. These are separate. Of course, we'd love to have you in both. And then minimum investment with us is 100,000.
All right. Couple questions here from David. Also, he says, what retailers could locate on the property that could also take advantage of OZ? And then he specifies something like a small strip mall on or adjacent to the former hotel site. Have any experience with that?
Yeah, we don't have any experience with that. I've only purchased the hotels that where the hotel is the only thing on the parcel, where usually hotels don't have as much parking as a multifamily does, just because people might come to a hotel in a taxi cab or a bus. And so we're coveting the land that we've got around the hotel to expand the parking in order to meet city requirements. On a couple of our properties, we've got 18-wheeler parking with extra space, but we don't have any experience with retail on the parcel, so I can't speak to that.
All right. Another question just came in from Michael. Michael says that he has his own qualified opportunity fund. Can his fund invest directly into your deals?
I don't see why you couldn't. Be no problem on our end.
Yeah, I think they are properly structured for that, Michael. So please do reach out if you're curious about learning more how that might work. Let's see. Jerry asks for the second property. I think the one that's up on the screen right now. This one
Mhm.
in Colorado here, Denver. He says it looks like you need to raise about $7 million in equity and then fund the remainder with a loan. Is that correct?
That is correct.
Okay. And then let's see. Another question is coming from Marlon, who asks, "What's the difference between what the $100,000 investor gets returned and what a $500,000 investor would get returned?"
Yeah, so we typically are for the $500,000 investors, we just go a little bit more aggressive on the pref, give a 9% pref and an 80-20 split. And with $100,000, 8% pref and a 70-30 split.
And that's not too uncommon that a fund or a syndication deal will offer slightly better terms for somebody who's coming in with a larger chunk of capital. So that's a
Mhm.
good question there, Marlon, and good explanation there, Alex. I think that is all the questions that we have for you today. Appreciate your support of opportunityzones.com and OZ Pitch Day. Thanks for presenting today, Alex. Really appreciate it.
Absolutely. Glad to meet you all.
All right. And please do reach out to Alex if you have any other questions for him. Alex, did we get your email actually? I am directing people to your website,
Dot
HotelSHIFT.capital.
capital. Yeah, and I'll put my email here in the chat, Alex Cartwright at HotelSHIFT.capital.
Perfect. All right. Really appreciate that, Alex. Thank you so much.
Thanks, everyone.